Hello, everybody. I'm Tom Sosnoff. Hello, Dylan Radigan. This is Truth or Skepticism. How are you, Dylan?
I'm good. I'm wearing my holiday velvet jacket for you here. I'm in New York. I'm out.
Yeah, what the hell is that? What are you? What is
I'm
that?
giving you this is a little December. I was over. I'm out pressing the flesh here in New York. I'm giving you a holiday Dylan. This is a rare treat.
What that I'm not ready for. I didn't even know there was a holiday Dylan. I
mean,
can I buy that at Costco? I mean, where do you get a holiday Dylan?
You could have one anytime you want, but it's very hard for most people. It's hard to come by, quite honestly.
Oh, okay. I mean, velvet.
You're on the list.
Velvet? Did you say
velvet? Black velvet.
Black. That you are so out of my league.
This is nice, Valentino. This thing has something. This thing's. It's an Italian black velvet.
I don't know where you I don't know where you got that. I don't know.
I wore it for you. I put it on just for this podcast. Actually, I was sitting here. I was like, I'm going to wear my jacket. It's December. We're in the month of so. I find this my busiest time of the year, commercially.
December.
Yeah, for the past few years, that these next 10, 15 days, the first half of December.
You know, I like working through the. I've always liked working through the Christmas holidays and stuff like that. It's always been like a favorite time line because it gets kind of, I like it because it's quiet in the office and, you know, everybody else.
Very productive time.
It is. I'll never forget once when we were first building Thinkorswim and it was Christmas Eve. And I was in the office on Christmas Eve and somebody called and they said, you know, they wanted help with closing a trade. And I'm like, yeah, I can help you. And they're like, who are you? And I'm like, you know, I'm just one of the guys that started this firm. They go, why are you helping me close a vertical spread? I go, listen, I have nothing else to do. Let's do this. Okay. It was like 2:58 on Christmas Eve, and I'm closing a vertical spread for some random person, and it was fun.
And yes, I find this to be a very creative time to the point of that story. And I think sometimes it warrants a nice velvet jacket. I bet you Tony would appreciate this jacket.
Well, he's got a couple of velvet jackets. So
I
bet
he does. I bet he.
He's moved on now. Tony's in the jogging suit bathrobe stage.
He's in the retired Gambino Little Italy jogging full.
He's in the classic. He's in the classic Italian grandpa mode right now. Okay. So he
hung up the velvet jacket.
Yeah, he's jogging suits all the way and bathrobes on the weekend, jogging suits during the week.
Jogging suits Monday morning when it's time to hit the bricks, when it's time to go.
Yeah. I always tease him. He reminds me of Tony Soprano going out to get the opening of The Sopranos when Tony would always go out and get the newspaper in his bathrobe. That is Tony to it perfectly.
But he's a man who can appreciate a fine velvet jacket and has worn them many a time, I'm sure.
Oh God, yeah. All right, what do we got today?
Okay, so here's the big. There's actually a lot of interesting conversations for us to have for the next few weeks. I'm quite excited about this, but I think the most appropriate one to start with now, just because I think that there's still a lot of currency for the Sam Bankman-Fried story, not because I want to talk to you about FTX at all particularly. I think we can come back to it. Well, they're going to regulate. We'll see what they do. We can talk about it. I think that's interesting, but I don't know that we need to do it again today. It'll be interesting to see how they regulate it, but that's not my point. My point is, are we seeing the consequences with FTX being the most recent anecdote, but the issues with Facebook, the issues with all sorts of management transitions and or conflict that's resulting from over empowering single shareholders who are typically non-conventional. People think of them as younger, but I'm just thinking more like the difference between good governance and bad governance.
Sure.
A 7-person board with a proper chairman that requires a 4-person vote that's no one person can control it. It's too big.
Yeah. So
perfect governance.
This is a very
You know,
this is a subject I feel very strong about, so I love it. Yeah.
so, and I mean, that's what I've been thinking about, and sort of, because obviously there's all this value in the single member governor, if you will, if you have the right vision. I mean, Elon Musk being the ultimate example, I think, of like the upside of it's like the best government is a benevolent dictator. Now, people say what's benevolent, but I don't mean who's. So there's obviously going to be examples of fabulous outcomes, right, under bad governance, right? And you're like, oh, good thing is bad governance. There's a home run. And you got plenty of examples of what we'll call good governance, which I'm saying is a valid 7-person or odd-numbered board with a majority vote for material decisions. And there's some best practices, right, from one of the law firms. The question, I guess, is when you say, because this is myself, I'm asking, what is best? Well, best for who, right? Okay. Best for the shareholder, best for the customer, best. That's what I'm interested to hear you sort of how you're thinking about this.
Yeah. So being part of both public and private companies that are worth a lot of money, I've been on both sides of the fence there, or both sides of that discussion. On the one hand, let's be very clear about the 7, 11, 15, 21 member boards with the chairman of the board being the person in the room with the alpha male in the room with the biggest ego, who may or may not be the brightest person in the room, but who's clearly been around the block.
That's bad governance. That's bad. I'm not here to critique boards. We could do that forever. Boards are F.
I understand. I'm saying
aspirationally good governance.
No. I understand. What I was going to get to is I have been in that boardroom before, and I have seen although the governance piece is important, I've also seen the complete dysfunction of that type of board beyond like your.
But have you ever seen it work? And would you rather take a flyer on a single supermajority shareholder super voter like Mark Zuckerberg, which obviously everybody say yes because it worked? But I'm saying, you didn't know it's Mark Zuckerberg. Would you rather be an investor with somebody who's a single member supermajority, I've got your money and I decide everything, or I've got your money and I report back to 3, 5, 10, 20 people and tell them what I'm doing with your money?
Okay, so like I said, I've seen the worst of the big boards in action, and I've seen the dysfunction around that. I have also been on the other side, not as a participant, but I've been on the other side as a shareholder, and I have seen the worst of the single player boards with either companies that have not survived, or B, companies that weren't big enough for the moment. The first company that comes to mind for me in this situation that I think is that there couldn't be something, there couldn't be a better example, is probably Robinhood. And because even though Robinhood had a board that consists of a lot of very high profile names, the reality is that they raised capital without giving up any voting rights. So essentially, even though they didn't control the board, as you would say, they controlled the voting rights, so that the board was basically rendered useless.
So that's my point. That's what I mean. I don't mean by shares held. I mean by governance.
No, I understand. And so I think Robinhood would be a classic example of a company that wasn't big enough for the moment, although the founders were incredibly bright and visionary. They weren't big enough for the moment because they lacked the know-how and the experience to get through the most difficult times. Now, there's been plenty of companies, that have had huge boards that have also seen, the same thing. GE is an example of a company that, failed miserably under everybody on that board.
Standard. I mean, they wrote their Harvard school.
Sure. I mean, IBM failed under this whole thing. Kodak. I mean, you can go through the list. I mean, there's graveyards.
Okay.
Full,
so then how do you, if your goal is, if people are the answer to the question, ideas are a dime a dozen. The right people in execution is the answer to all questions, whether it's, what doesn't matter, the biggest or smallest business or any activity on earth. And helping those aligned interests is the best way to get people to do what you want. because you have both only benefit if you work together. There's a point where aligned interests falls apart and decisions need to get made, either single member, super Robinhood, let's say, or super board, GE legacy, and everything in between. And I guess I've had two questions. One, do you believe that this crop of young people that's been empowered with Robinhood being an illustration, with a Silicon Valley derived Mark Zuckerberg originated with their lawyers, where it doesn't matter who owns what stock, one person controls all the votes? It's a legal structure, right? That was invented for that purpose. Like Robinhood used it. One, are we recruiting the wrong CEOs because of the system? And two, is there a better system? I guess would be helpful.
Well, nobody recruited Mark Zuckerberg. So
but I'm saying is the system rewarding, allowing people that shouldn't be CEO to stay on longer because of the legal, the same way the poison pill 40 years ago allowed hostile takeovers at Credit Suisse, First Boston, and KKR because the poison pill didn't exist. And so you could buy the stock and take over the company and fire the board. And then the lawyers invented a defense, which was the poison pill. And then the Valley did the same thing where they said, listen, you can just sell 90% of the equity to anybody, but you can keep 100% of the governance and the voting rights. And it became commonplace.
You keep bringing up Zuckerberg, but I think that if you look at the case of Facebook from where they started to where they got to, building a company from a dorm room to $1 trillion is in market cap. Doesn't matter where it is today. But when you can build a company from 0 to $1 trillion with 2 billion users, nobody that invested in Facebook nobody
uncontested, but uncontested. I mean,
okay. Well, then I don't understand the argument with respect.
No, I'm saying that's the basis for the legal structure. Not everybody. My point is, not everybody else is Mark Zuckerberg. So all of a sudden, everybody wants the same Mark Zuckerberg legal structure.
No, but everybody wants the same Mark Zuckerberg results. So they're willing to, like if you were.
Which is why Robinhood didn't have to give up any voting rights to get.
That's
money.
Exactly right. That's exactly right.
I'm saying is that a problem? Because everybody's looking for the next Zuckerberg and they're willing to give up all their voting rights. And
it's not a problem.
You're empowering.
It's not a problem, except it puts the onus of the investment on the decision maker. So everybody invested in FTX with zero controls and zero board because of what Mark Zuckerberg did 20 years earlier.
That's my whole point.
Yeah, I understand. I understand. But that's never going to change. Do you know what I mean?
You're saying it doesn't matter anything that as long as there's once anybody of any time in any age invents a magic money machine, whether it's a valid social media empire or an invalid anything, it doesn't matter, that they can get money without forfeiting control.
It doesn't mean that. What it means is that given, you have to make that assessment. There are a lot of people, Elon Musk included, and many other people that turned down, the opportunity to partner. I mean, one of the firms that we invest in, Zero Hash, turned down the opportunity to invest and to partner up with FTX because they didn't believe them.
Because they weren't willing to do a deal with no terms. Basically.
Other firms like Elon Musk said he didn't take any money from FTX on the Twitter deal because he didn't believe them. He thought, the CME didn't believe them when they tried to partner with them to do crypto deals. So there are lots of people out there that made the call that said, hey, you know what?
Okay.
Something doesn't smell right.
But would you rather, is that a better governance to have the investors basically be the board at the time of investment, is what you're describing, which is saying,
yeah,
I yes vote or I no vote when I write the check.
I mean, isn't that how free markets actually work?
For sure. No, but that's not necessarily how $1 trillion enterprises operate successfully over time.
And it is really rare to get to the point where FTX got to with as little governance as they had and as little corporate structure as they had, except that the decentralized world was a new frontier. And that new frontier has been blown up. That will never happen again.
We got it.
And it was outside of anybody's jurisdiction. It was almost like the meme stock, a whole meme stock, revolution. It was, it was, I would say, the FTX situation and the situation among a lot of these digital asset firms. It was the perfect storm, timing wise.
Well, also, it was, if you really look at it, it was just a straight rip off of the old, a designated market maker funding their own account.
It was even way worse than that. But yes, of course. But it was free money. There was zero interest rates. It was free money. Everybody was sitting on a boatload of cash, and nobody wanted to miss the next. That everybody knew there was some form of something weird going on, but they thought there was one more person that would pay a little bit more above them.
And that person was Alameda. That's who would pay it on the other side at FTX. In this case, we learned. Anyway, that's neither here nor there.
That particular case is neither here nor there. But what happens in these situations is that something normalizes and brings everybody back into, brings everybody back to reality. And lately, it was FTX. Before that, it was Robinhood. Before that, it was some other.
Does that change the no terms? That whole no, does that, like, in other words, I agree with you that buy-in from the investors with a single point of creativity is the best way to create something.
Of course.
But it's not necessarily the best way to operate and manage something after it's been brought into creation, which I'm sure you also agree with that.
Of course. In fact, I want to give you an example. We looked at a deal in the financial service space, small company, and it was in the digital asset space. And it was after Robinhood had made had raised a ton of capital, but after the terms of their capital raise, where they kept all the equity, was out in public because they were a public company. And the firm that we looked to the deal with said, just so you know, we're selling this much of the company, but we are keeping the voting rights.
Governance stays with us.
Governance stays with us. And we said, what are you talking about? And they said, yeah, this is the new, this is 20, Tom, get with the program. This is 2021. And this is what happened. This is what Robinhood did. They told us this is what other firms are doing. And if you want to participate,
Zuckerberg invented this back in the day.
If you want to participate, this is what you have to do. And we very politely said, listen, we like your company. And it turns out they're no longer in business, basically. But we like your company, but we are not going to invest we're not going to give up, our voting rights. We just don't do that. So we walked away. In hindsight, it was a great walk away, but we had no idea at the time. But what's so interesting is everybody had the option of walking away. And the people that were, like we're sitting here talking about, like, these are very unsophisticated investors. No, they're not. This is Andreessen. This is, Silver Lake. This is
Sequoia.
This is Sequoia. These are your biggest private equity firms in the world.
Sequoia is the Goldman of the Valley right now.
Right. Nobody is sitting back and going, "Oh man, they picked off Andreessen Horowitz." Like, are you kidding me? So this is a very different, this is a very different world, and they got what they got,
Unquestionably. But what it brings up for me for today is, does that then catalyze a recalibration on the sort of standard for governance, understanding that, I guess, because the circumstances for creation end up when they were creating a governance structure that's not good, right? But it's also,
is governance any different than value? So in other words, is it any different if you have all the leverage over governance? You probably have all the leverage over value. So which one's worse? Like in other words, was it better to have your voting rights and pay $100 million for something that's worth $100 million to something worth $10 million today? Or is it better to have, what I'm saying? Like there's a lot of things involved. Governance isn't all there is to it. There's also valuation. Everything gets reset. And when things get reset, then, everything gets normalized until it gets out of whack again.
Yeah, we know.
Isn't that a market?
Of course. But I feel like you're going to see, because the thing is, the GE or IBM board, or the ultimate would be the Federal Reserve Board, I suppose, in terms of, like, conservatism and protocol. They're both terrible, in my opinion. I'll be quite honest with you. I don't want to.
I would agree with you.
I find both of them very uncomfortable, and I imagine most people don't like either.
Yeah, we have a solution, by the way. We've never written a book or a paper on this, but I have a solution. And I learned this from a buddy of mine that's built a couple of companies that are worth a lot of money that I think he's really smart. And the solution is called the 30-minute board, which is don't the reason that you have professional board members that aren't qualified that don't have the know-how to provide really good input for your company is because they are professional board members. It doesn't matter whether they're sitting on the board of a fast food restaurant or a brokerage firm
or a health insurance company
or an insurance company or a manufacturing firm. Okay. They're professional board members. They have some success in their career somewhere, and now they've decided to retire and be board members. To me, there's no value in that. I mean, I sat on the board, not on the board. I wasn't on the board, but I was in all the board meetings when we were bought out by TD Ameritrade. Every person on the board was a billionaire, but they all hated each other, and it didn't matter. It was the most dysfunctional thing in the world. I'm sure today the boards are even worse. We have this thing called the 30-second board. We don't have it today.
Hang on. It was 30 minutes
30 minutes.
That was 30-minute a lot shorter.
So here's the beauty of the 30-minute board. You bring in really smart people that are currently running companies, not professional board members, but running companies that are successful companies that are in the business today. But so that you don't make them fly anywhere and you don't make them ruin a day or two or have to go out to dinner or anything else, you promise it's a 30-minute board meeting. And therefore you attract this incredible talent. You don't have to pay them anything or anything else, essentially. And you say, listen.
But also, and that's great to harvest expertise and enroll partners.
Exactly.
But that doesn't help you make decisions. That doesn't solve the issue of governance.
Boards don't make business decisions. Boards approve business decisions, or they decline them. But they don't. You don't want your.
But the point is, what is the scope that they have the authority to approve?
Yeah. So you bring in this 30-minute board concept or the 60-minute.
You give them real authority in that 30 minutes, or is it just an information gathering?
Really smart people that run businesses can make decisions in less than 30 to 60 seconds. There's no reason to have a multi-day or committee-based board meeting.
Listen, you should write a book, The 30-Minute Board. Someone will come out with a 29-minute board meeting. It'd be like
we've thought about writing a paper on it because it's such an interesting concept, and it's always worked for us. So we had this thing. We've done this here. We built Tasty and we built Thinkorswim on the 30-minute board. And that way we acquire
the best thing about it is the upgrade in the talent.
Of course. The upgrade in the talent's the whole thing.
Of course.
That's how you attract talent.
Right.
You actually get skilled talent that can make quick decisions because they've only got 30 minutes.
Yeah.
FTX, the whole FTX scandal never would have happened if they did the 30-minute board. It wouldn't have. Now,
I believe it.
Would that have saved Robinhood?
Right, but remember who's on the 30-minute board? They're calling the Sequoia guys, the Andreessen, like they're calling theoretically people that are in the business right now. Quite honestly,
they had the skill on their board, but they didn't have the voting. So that you have to. There's always some piece.
Right, but does your 30-minute board have voting rights?
No.
So that's great for expertise, and it's a great way to build a business. And I love the idea, but it doesn't change the single.
Well, somebody may have a voting rights of some percent.
But in your world, your life, your 30-minute board does not have voting rights.
Well, in our businesses, you own what you own. Like, in other words, you don't have somebody else's voting right.
Of course.
I mean, that's the way most businesses are. If you own 10% of the business, you have
Right, but
10% of the
businesses
votes.
also have managers and CEOs that have authorities to buy other companies and pay
Sure,
vendors and
sure,
change budgets for
sure.
new divisions of the company. I mean, we just watched Disney have to bring back their old CEO because, however, the new CEO who's now gone was managing budgets, for instance, and where like what gets funded and what does the Disney shareholders own what they own,
Yeah,
but they're not the
exactly.
people that decide whether the cruise ship division gets another 300 million to paint the ships this year in China.
I
You
mean, the
know,
Disney example is pretty normal in my mind. That's pretty normal. I think that getting back to
I
the
agree.
FTX and the Robinhood and the Zuckerberg things are, that those are different.
Right, but I can't seem to pin you down on what because your 30-minute board is lovely, but it doesn't do it maintains single party governance.
Um,
It
it
maintains the
maintains
Zuckerberg, Robinhood,
it
FTX
maintains
governance.
the governance that it maintains the distribution of governments the way the equity is set up, which is the way it should be.
Okay. So your ultimate structure is basically pound for pound. There's no multi-class of stock. There's
No,
one
but
class of,
there is when you have an independent board, there's the board votes are all they're all equal.
yeah. And then
Yeah,
the shareholder votes are equivalent to the shares held.
yeah, of
Or
course,
the without playing games with the voting
of
rights
course,
like the West Coast
of
kid.
course, of course. But the board itself, if you have a 7-person board, you're going to have, you could have 4-3 without
So for
the
instance, Elon Musk, I think, owns 20 or 25% of Tesla, give
yeah,
or take.
but the board may be, well, let's say the Tesla, since it's a public company, the board may have 11 people, and he's still got to win. He's still got to get 6 votes.
But he also decides who those people are.
That's right.
Makes it easier to get votes when you choose the board.
But that's why you're the CEO.
Right. So that board, but ultimately, the list goes to the history of Wall Street. I mean, we're really in the roots here,
Sure.
which is with the power struggle between the shareholder and the management.
Yeah.
Period. However, whether it's going back
Yeah.
to Kodak or to Sam Freed, anybody.
Yeah. Yeah. Yeah.
With your structure, where you have the shareholders in the 30-second board, the shareholders have the power to fire the CEO, as I interpret your structure.
The board has the power to fire the CEO.
Well, the board would have the power to recommend it, but in your structure, the shareholders would have to ratify it with a vote, I presume.
Probably, yes.
So the shareholders have the power to fire the CEO.
Yes. I guess that is correct. I mean, in the case of Apple, the only time I can think of it is in the case of Disney, the shareholders didn't vote. In the case of Apple, the shareholders didn't vote.
But my point is, most people don't use your structure for this exact reason.
It's
The
fine.
reason they create multi-class voting stock and
Yeah. I understand, but I mean, let's face it, the system is broken.
but I'm not blaming. I'm trying to. What I'm getting at is, would you rather see the power reside in the shareholders' ability to fire the CEO, along with the Carl Icahns of the world, if you will, in terms of the people that are like, I'll buy stock and create a new boss? Or would you rather see it live with the incumbent CEOs who cherry pick boards and have multi-class stock, so that ultimately the CEO, you have to fire shareholders like what you're talking about with the people that didn't invest, for instance, in FTX?
Yeah. So the dangerous thing about shareholders is that there are a lot of shareholders don't have any idea, with all the index funds and ETFs and everything else today. There's so many shareholders that have no idea.
Ignorance in the shareholder base is an issue.
Yeah,
relative to management.
Yeah, so you almost have to have it as the board makes the decision.
The board hires and fires.
Yeah, almost has to be.
But then when the CEO selects the board, and that, like, your friends are less likely to fire you.
Well, that's true, but there's usually a certain number of independents on the board. Mutually agreeable independence, but yes.
Well, Sam Bankman-Fried had none of that.
That was a complete abuse of anything. Like, I have no idea how they raised any capital that they raised under this. I have no idea what happened there. It was just, it was a pure case of FOMO. I don't know how he pulled it off, because he's not even a good
I think he
talker.
was running single member disregarded LLCs that were just him with bank accounts.
Yeah, it's complete fraud. Nothing. I mean, there's nothing to say. It's just the craziest case of just
But do you
blatant
think
fraud
that
ever.
younger aged executives, 25 to 45-year-olds, will be inappropriately maligned as a generational category, that the mythology of the young exec CEO is tarnished?
Well, Bernie Madoff wasn't very young.
I know, but no one even remembers him now because that's how old we are.
I mean, yeah, but there's
That was
I
12,
don't think
13 years ago.
fraud is defined by age, because I don't think anybody sets out to do that. But I don't know if we can say that. I mean, there's a certain level of inexperience, but again, I think what I think the CEO of Coinbase, Ryan Armstrong, put it best when he talked about Sam Premium. Like, it's like, you don't misplace $8 billion. Like, there's no such thing as an accounting error for $8 billion.
Over years. I mean, it's not like you could have a fat finger on a trading floor for a big number with an extra zero on the Goldman bond desk. That's a misprint. But it's not like it was a one-day $8 billion fat finger. It was over at least 12 months and many transactions.
You can misplace a few dollars. You can't misplace a few billion. I'm sorry, it can't be done. So yeah, that was an extraordinary case, and it was an extraordinary time. But I think the topic today of, is there
No, the 30-minute board, the most valuable thing from today's podcast, unequivocally, is the book. Because the rest of this is interesting enough, and if you're a student of business, I'm sure this is a pleasant conversation and insightful. But the real value for the people of the world is better boards.
the
The 30-minute board.
It gets back to, we built Tasty around the idea of quick decision making, and my feeling is the best boards I've ever been associated with make incredibly fast decisions on everything, and people that can make fast decisions are usually the best board members, and usually the most valuable, and usually the most knowledgeable. And so there is no reason to go
Those are
longer
the
than
chapter
30
headings: knowledgeable, you just outlined all of your adjectives are chapter headings for the book.
Yeah, yeah. But that is it. It's the 30-minute board that changes the world.
I mean, I don't know what you're doing the rest of the year, but it sounds like there's a worthwhile project to add to the somebody needs to hire a ghostwriter.
Yeah. Well, it's so funny because we used to joke about that. Christy and I used to say, can we do this in 15 minutes? And she's like, Tom, we cannot do a board meeting in 15 minutes. Like, I'm like, well, then we'll call it the 30-minute board, because, and the funniest thing is, so you go to somebody, like, I'm not going to mention names, but we went to one person that runs a multi-billion-dollar company. We go, we know you're busy, but we'd love to be on our board, because he was a small investor. And he goes, Tom, I don't have any time. I can't do a board. And we said, 30 minutes once a quarter. He goes, 30 minutes? How are you doing that? Oh, that's our board meetings, 30 minutes once a quarter. And I go, for you, we would do 15. And he goes, I can do 30. And that's how we got him. And brilliant guy. I mean,
he really created the desire to get insight from this one person. He really created the 30-minute board.
I mean, that
was his offer. He's like, my maximum offer is 30 minutes.
And he was one of a couple of people over the years that took the same approach with, and it actually works. And for that, you get somebody that's not, that's been professionally sitting on boards for 25 years, that's 75 years old, or versus somebody that's 35 years old or 40 years old that's in the prime of building multi-billion-dollar businesses and that can make incredible decisions and help you. And it's, and it was definitely valuable.
Well, no, I think because the most uncomfortable and unpleasant part of today's conversation was both the dissatisfaction with either the single member super shareholder or the GE board of directors. And I think all that speaks to the value of the 30-minute board and the need to share the gospel in some sort of a published manner. Jack Welch became like a management guru with his management system. I mean, Tom Sosnoff can do the same thing on the third, with the third. It'll be like the big movement in the upcoming Roaring '20s will be the Sosnoff board style. People won't even know who you are. They'll just be like, we're going to do a Sosnoff board. It's like, it'll be like a thing.
Great. All this work, and that's what I get. That's all I'll be remembered for.
And that's your legacy, man. People are like, yeah, keep it quick. You're going to be long gone.
The 30-minute board. We don't even have to buy lunch for the board members.
100. You'll be 100 years from now. They won't even. It'll be some company in Spain. They won't even know. It'll be in a different language. It will have gone global, and they'll be like, "Yeah, this is great. We get better people. No time. Costs us nothing."
There you go.
It's the Sosnoff board.
There you go. I'm glad I could add something to the discussion today.
No. I think this is an offering to the world. We need to have a discussion. We'll discuss this further.
So the answer to the, does it matter if you're young? Is it all about, young people and experience? Is there something else to it? And I don't think so. I just think the system's broken. I mean, I can understand why certain companies don't want to do giant board meetings and things like that. And I can also understand why I get both sides of the equation, but I think that there's a solution.
But we shouldn't blame the kids is the holiday message. Don't let Sam tarnish the kids.
No, but there's a reasonable amount of responsibility that should have been with the investors as well.
With Sequoia, with Andreessen Horowitz.
I mean, if you came to me and said Sequoia, Silver Lake, Andreessen Horowitz, TCV, TA, if you listed off 5 of the biggest private equity firms in the world, and then I said to you, and I said to you, well, yeah, and GA and everybody else, and you have multi 20, $30 billion firm after another, and they all made investments, and they said, Tom, would you like to invest? I'd be like, and all those guys vetted the deal, and they'd be like, yup, and then I'd be like, sure, I'll take a shot. Not even for 1 second thinking that none of them did any work. It blows my mind. Yes, I probably would have done the same thing.
Who wouldn't? If somebody said, "I'm going to put you next to Sequoia in this deal, same valuation, blah blah," all you have to do is write a check, get no voting rights, and they did all the work. System's broken. I mean, this is a different conversation because what a lot of these firms, whether it's the VCs or Goldman, is what a lot of them are doing. You probably do, but is they're writing checks to McKinsey and Bain, and then they're laying off their judgment because they're like, I'm the same way you don't want to vet it. You're like, Sequoia vetted it. Well, Sequoia's like, I don't want to pick on Sequoia. I don't know what Sequoia does. That's not. But my point is that you have these principles at investment firms that then they don't want to do the diligence either. So then they pay Bain and McKinsey big checks every month. And Bain and McKinsey send them reports. And then they pick investments based on the McKinsey and Bain report stack. They're like, McKinsey gave, these are the 5 stars. These are all the 5 stars from. So it's laziness. Let's be quite candid. Whether it's yours or mine, when we were like, I'll tag along with Sequoia, do no work, or the investment manager themselves. Anyway, it's an interesting. It's a parable in laziness at the end of the day. Everybody wants money for nothing, right? You're like, if the kid you give him $1, he gives you back $10. Like, everybody on earth will take that deal.
I hear you. It's crazy. That's a fun discussion.
I mean, you're dealing with human nature here, so I guess you have to manage your expectations.
Yeah.
Thanks for the education. That's a useful. I think that we've discovered some real jewels here. I think that the 30-minute board is it's a globe. We need a Harvard class. You need to go teach a semester at Harvard.
It's 1:50. Dylan, I'm going to let you go, and we're going to see you next week.
Yes.
Looking forward to it. Have a great week. And I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. We'll see you every Wednesday at 1 p.m. Central Time. Thanks so much.